Hello, it's Kim. A question I get asked a lot is when I'm speaking to 35 and 40-year-olds, what am I going to do with the death benefit of this life insurance? Because we think that we don't care about it. And so I want to share with you something today that's from the Truth Concepts software that my husband Todd Langford writes that proves the value of the death benefit for a 35 or 40-year-old out there in the future when they're in their 70s and even into their 90s and beyond. So we're going to take a look at a 35-year-old person that's 35-year-old today, but we're going to look at their life out in the 70s. And we're going to pretend that they have $3 million of assets. And we're going to first look at the period of 20 years from 70 to 90. So we'll put in $3 million, and these are taxable assets. So this could be like a mutual fund or a stock account or something that's not in a retirement account. And we'll pretend that that account can earn 5% because we're in the conservative phase of life. So we'll just go with a flat 5% rate of return. I'm not talking about any particular investment, just a general 5% rate of return. And you can see if we take the interest-only approach, which is what most typical financial planners recommend, that we have this $3 million account, and I'll look at some graphs here in a minute, but just so that you can follow with the numbers, that's earning 5%, kicks off $150,000 of income. Now, this person probably also has about $50,000 of either Social Security or maybe a pension or something like that. So I'm going to put that in as well because that's going to force the $150,000 up into the higher income tax brackets, which people think they're not going to be in retirement, but that's a huge fallacy. So you can see the tax payment is level because we're taking interest only out of the account. And this is an interesting fact. The financial institution gets the $3 million while you, as the owner of the account, get $119,000 per year of income. Now let's just play that out a little bit. Let's pretend, for example, that maybe you didn't get to earn 5% and you only got to earn 3%. Well, then you would have $73,000 of net income. So interest rate matters a lot if you're focused on using your account as interest only. And this would be for the person, I'm going to put this back to 5, that did not have any life insurance or whatever they had, they'd gotten rid of. Maybe they had group term or regular term and it's all been canceled. They really don't have any choice but to take interest only because they don't know how long they're going to live and they have to leave that principle in place. So that's what we're going to put on the left-hand side of the screen, the distribution 1, if you will, and the person that has bought term insurance, canceled that term insurance, and now just has their asset left. Well, what if we could have a different perspective on this, a prosperity economics lens to that same account? So over here on distribution 2, I'm going to put in the same $3 million and the same 5% earnings rate. But this time, instead of taking interest only, I'm going to do what's called a pay down over this 20-year period. So I'll just mark in here that we are from age 70 to age 90 in this time frame. Now, you'll notice with a pay down, the $3 million account is zero at 90 years old. Now, hang tight for what we're going to do after the fact, but notice that at the same 5%, because we're doing a pay down, the gross withdrawal is $240,000. So we're already quite a bit ahead from an income standpoint. Nevertheless, it gets better because we are doing a pay down, meaning we're taking principal and interest off of this account. Our taxes go down per year, every single year. We're just using the same assumed tax rate, but the actual dollar figure goes down because we're taking principal out of the account, which means the spendable income goes up. Now, this all sounds great from 70 to 90, but as noted, you'll see here that the account is at zero at age 90, and with people living to 110, 120 years old, this is something that we need to keep taking a look at. But before we do that, I do want to show you what the account would look like if it earned 3%. So earlier with distribution 1, we said, okay, we had a 5% account and then a 3% account. Now let's take a look at what happens with this at 5 or 3. And you'll notice that the net spendable income is still well above the income that we had when we took interest only off of the account. Now, this person on the right, the distribution 2 person, if you will, we are going to assume that at 35, they bought life insurance and they built that life insurance up to the point where they were able to stop paying it at 69. So from 35 to 69, they paid the premiums as a savings vehicle. They put money in, saving like a verb, to store money, saving like a noun, in the cash value of life insurance. Now that's not included in the $3 million. That's a separate account. It was their emergency opportunity fund, right? And it sat there alongside all along the way. So let's go add that to this picture and see if we can make a difference on this right-hand side with what happens at age 70. So we're going to add the life insurance in. Now remember, this was bought at age 35, but we're looking at it out at age 70. We have a couple $1 million of cash value and a $3.2 million and growing death benefit. Well, with the presence of that money, we can now leave the pay down set at the 20-year period, but stretch our view of their personal finances out over 51 years, basically taking them out to age 120. And because first of the presence of cash value, and second, because of the presence of death benefit, we can create a lot higher income stream that continues well past the time when the account was paid down over that time of the first 20 years. Now we're out at age 90 and we're still showing income coming, again, first from the cash value, but because of the presence of the death benefit. So that presence is acting like a permission slip for the first 20-year period of age 70 to age 90, because if you don't have that, you're not going to be willing to pay down the account. And so we can see the flat income continuing out over this time. And we could even go in at this point, because of the presence of the death benefit, and add a reverse mortgage. Let's say we had a house that we had owned this entire period of time. You know, it was a normal, maybe $500,000 house, and it's grown and its value is a couple $1 million now. Well, that would kick off about $120,000 reverse mortgage that would be completely tax-free. Now, so I've added in the reverse mortgage from age 90 on, because we want to do reverse mortgage as late as possible. Now, if you're struggling with thinking about living this long, I encourage you to do some research on longevity, because I think a 35-year-old today is going to easily see 110, 120 in terms of age. So you'll notice I have $120,000 of reverse mortgage, tax-free income. No way that you would do that if you didn't have a death benefit. And then $160,000 from the life insurance policy cash value itself. So when I include this other net income, now our total is $280,000. This is after tax income, some from the life insurance, some from the reverse mortgage. And it enables a much better picture of income over their lifetime, clear out now to age 120. So if we take a look at the graphs, we can see on distribution 2, we have the actual account here in blue that is spent down or paid down over the first 20 years. The account in purple is the death benefit or the legacy account of the life insurance policy itself, or we could go look at the cash value of it, and you can see the purple section is still about the same, because in the later years, cash value and death benefit are fairly equal. Now, if we want to compare the first distribution to the second one, we can see here that in the first distribution, where all we had was interest only over this whole time, and our taxes were the same over the whole time, versus in distribution 2, we had our decreasing taxes for the first 20 years, and then notice how our income goes up because we're able to have both income from the life insurance cash value and the reverse mortgage. And then all along the way, we have this extra cash value. So if we needed even more money for whatever reason, we would have access to that. And then, of course, the death benefit is there to pay off the reverse mortgage if that's what the children want, or grandchildren, or great-grandchildren. And if they don't want the house, then they can just let the house go back to the bank, take whatever profit after the bank sells it is available, if any, and keep the death benefit for themselves. So this comparison here with the two graphs is very instructive because you can really see the pay down and you can see the increased income over time. The first green bar is the life insurance income. The second green bar is the reverse mortgage income. So I hope this has helped you answer the question, what do I as a young person do with the presence of the death benefit way, way out there in the future that will benefit me? And the answer is it's acting as a permission slip to give you more cash, more capability, lower taxes, and the ability to do things like reverse mortgages, charitable remainder trusts, even pension maximizations. If you have an opportunity to make a choice around a life expectancy payout, one could be from a pension, one could be from an annuity, etc. These are all the types of things that work with acknowledging the utilization of the death benefit while you are living to help out your own personal financial situation. I hope this has been helpful. You're welcome to reach out to me if you have any questions.